Hey everybody, welcome back to Investing Unscripted, where you ask and we answer the hard questions about investing and stuff tied to investing. How was that for an intro, Jeff?
I see what you did there.
It's pretty good. That is indeed Jeff. I've already said that. I'm Jason Hall. Jeff has a last name. Santorini?
It's whatever someone mispronounces it as.
Santoso.
Is what my last name is.
That's the big one. Jeff Santoro, ladies and gentlemen. He who is the voice of the people. How are you, buddy?
I'm great. You know, I always enjoy doing the podcast, but some days, for whatever reason, I'm like particularly feeling good about it. And today's one of those days. So,
well, it's a day that other people did the work for us to prepare for the show.
that could be it.
Yeah.
That could be it.
Yeah.
Yeah.
But in all seriousness, thanks. We got some great questions from listeners. People sent some stuff via email. We got some stuff from our starter position subscribers, our $5 a month membership, the premium membership to get you access to our Discord. It's a lot of engagement in that. So we got a couple questions, a couple of topics we're going to share from that to give you kind of a little peek into what we talk about there. But overall, we've got some good stuff to talk through, Jeff.
Yeah. And before we dive into it, I want to just remind everyone who's listening, if you've never heard a podcast or a mailbag episode on our podcast before, or if you are a new listener, you can send us questions whenever. If you're listening to a show and have an idea, if you're listening to another show and have an idea, if you're
listening on Spotify right now, you can ask, like in Spotify, you can ask a question.
Yep.
And we get those and we use those for the mailbags when it's appropriate.
Yeah, but you can literally get them to us any way you want. We go to all the social media accounts, we check the email, we go to YouTube, we check out everything. So if you have a question, send it our way. Happy to answer it. And while I'm doing a little housekeeping here at the top, Jason, so it's been a while since we've had a new review on Apple Podcasts, and it's been not as long of a while since we've had a new star rating. So right here at the top, if you are a fan of the podcast, if you've been listening and enjoying it, the best thing you can do to help us out is to send it to someone directly. And the second best thing you can do is give us a 5-star rating on the podcast apps. And if you're on Apple Podcasts, give a review as well. That helps the algorithm put the show in front of more people, grows our audience, helps us out. So we say it in every episode, but it doesn't always happen. I know we have more listeners than we do reviews right now. So if you could just take a second to help us out, we would appreciate it.
Just do it right now. If you're driving, just stop right in the road. You
don't even have to pull over. Just
stop.
In fact, it's probably best if you slam on the brakes.
Yeah, do it fast. Well, because you're going to get a lot of people that are going to be like, what are you doing? And you'll be like, well, I'm rating this podcast. Let me share it with you.
Yep.
And like that, you will have
one more thing. You know, we say at the end of the show, these are just our answers and you should do your own, make your own decisions. That goes for driving as well.
Yeah. Yeah. Not driving advice.
Yeah,
for sure. Okay, Jeff, we're going to start off with one from Discord. This is a longtime friend, somebody that you and I both have gotten to know better in the real world over the past couple of years. And this is one of my favorite channels in our Discord group. It's our Tell Me I'm Wrong channel, where we encourage people to do that. You have these ideas, Jeff. Sometimes you have a lot of conviction in an idea, but you don't know your own blind spots, right? So one of our ideas with the Tell Me I'm Wrong channel is to be able to post your idea, your thought there, and for the people to come in and be contrarian, whether they agree with you or not, but to challenge that. And that challenge of ideas can be really useful. This was, I think, a really good example of one that's a perfect one that you might have believed one way about this a year ago. And just the fact that it's getting pulled into the political sphere might have you thinking about it in a different way.
Right. So Jen posted a news article about Trump the other day, said that he was going to direct the SEC to end the requirement that companies report earnings quarterly and going to every half year instead. So twice a year instead of 4 times a year. And apparently he got this idea after talking to the president of China, because I think that's how they do it on the Chinese markets.
European markets.
Yeah. But I think the article said this came after a meeting.
No, it did.
Yeah.
But the point is, like, obviously you say China and you say market openness and transparency, and those don't really relate.
Right. No, it's all the
Europe.
It's really
It's a common standard in Europe. Yeah.
Yeah. So then Jen posts the article and then said, so the non-cynic in me is wondering if this is a good idea. I mean, we always complain about the dog and pony show that is quarterly earnings, but the cynic in me is saying, if you don't report quarterly, you don't see the tariff impact so quickly. I'm sure I'm wrong about one of those. Give me your thoughts on this.
I love this question. And I didn't really wade into it too much in the Discord because a lot of other people chimed in. And this is one that I've gone back and forth on over the years, because this isn't the first time that it's been brought up, because we do know that, like, the work to do this, especially for smaller businesses, can be, I don't want to say onerous, but It's not nothing. And we do know, and we've talked about this, we've done episodes talking about the power of incentives where it can affect the way companies report, whether they recognize an order or not. Things that companies can do in the real world that to manipulate their numbers because they're managing to Wall Street's expectations, right? Versus focusing on delivering the results for the long term and making the best long-term decisions that are going to strengthen a company's competitive advantages, make it more competitive, make it more profitable over the long term. So we know it's certainly those incentives, they absolutely have a role. And taking that spotlight off a couple times a year, you like to think that companies are able to just focus internally and less looking at the investor class out there and the investment banks and they're the sell side and buy side analysts that are covering the bank and are covering the businesses and all of that kind of thing. And you like to think that it would be a positive. And there's plenty of people that listen to this podcast that are out there that don't necessarily always see eye to eye with President Trump, particularly when you look at his track record as a business operator. It's not the best business operator out there. I don't think anybody can argue with his ability to promote maybe the best ever. But when it comes to actually operating a business, he hasn't had a very good track record when his hand's been on the wheel. And then just factor in the political aspect, right? A lot of people are immediately going to just disagree with whatever he says, right?
But to be clear, he's not the first person who's had this idea.
No, he's not, right?
Yeah.
He's not.
So that's worth mentioning as
it is.
As
I think it is. But I think there was one response in the Discord that really stood out to me. And it's interesting that it came from someone who, like, on first blush, you might think, is going to support this, right? Because there's less focus on the short term and less management's focus on the business. But our good friend Tyler Crow, who chimes in on occasion in the Discord, pointed out that quarterly reporting standards are not in place for the good actors.
Right.
And that did stand out to me because it forces companies that are burning cash, that are selling lots of stock and secondary offerings and private placements, increasing, diluting investors, doing these other things to raise money besides actually generating operating cash flow, forces them to disclose that every 3 months.
I have conflicting feelings about it. I like quarterly earnings because I like getting updates on what the company is doing, right? I'm a guy who likes to make spreadsheets and keep track of data. So selfishly, as much as I agree with the argument that it goes counter to what we say we stand for in terms of long-term investing and looking decades out instead of months out, I'd be sad to see the quarterly reporting go away. I also wonder how many companies, if that became the requirement that you only have to do twice a year, I wonder if some companies would continue to do quarterly earnings because they want that communication with shareholders. I also worry that one of the things that I've used as a strategy for myself when I find myself thinking too much about stock movement is to go back and look at the most recent quarter. So let's say it's today. We're recording this on September 16th. So let's say it's September 16th and a stock I own is down 15% over the past 2 weeks, just having a bad couple weeks. I might think to myself, what's going on? Things are going poorly, getting worried about the stock. But then I can go back and reread the earnings report and see where things stood, at least as of the end of June, which is not that long ago. But if we were in a world where we had twice a year reporting, I'm going back and looking at data from December, which when you think about what has happened in the world since December, right? Like the tariff stuff was April 2nd. This is 3 months before that. Like that's wild to me that the only anchor I'd have to reality in terms of what the business is doing would be before the second Trump administration even started. So when you think about how fast the world moves and economic policy can move now, especially, I don't know, man. Going back 6 months would really worry me in terms of what people are hiding, what the impact is. Like Jen's point about, we would have gone from all that April 2nd stuff until this last earnings cycle. If we stayed on like a December and June twice a year thing, that'd be the first time we get an update on tariffs. So imagine what the movement would be for these stocks.
So I don't think that's necessarily the case.
You think there'd be more like interim updates?
There would have to be. And
voluntary ones.
As a starting point, companies are required, they are legally required if there is a material change.
True.
To disclose that to the SEC. That's what this 8K is for. It is disclosure of a material change or press release. So for example, if a company hires a new executive, they're going to issue a press release and then they're going to file an 8K. If a company issued guidance earlier this year when they reported their fiscal year results and they issued guidance And part of that guidance was margins or something around taxes or something like that. They would be obligated based on tariffs to provide an updated guidance and disclose that with an 8K. They would have to do that because that is a material change that they would have to do that.
But let me push back at that because I don't know what's the timeline on something like that, because you could have made the same argument that between Q1 earnings and Q2 earnings, a lot of businesses' outlooks changed because of tariffs and there were no 8Ks talking about it. They just waited till earnings.
Well, that's close enough.
That's my
I
point.
can tell you, but if we're talking
You can
about,
see a business going like, we'll update them in June.
I think it would be less of that than you would expect, because I think companies would also be concerned about being on the wrong side of their regulators with this change. And I think also you would see the SEC would provide some guidance. There'd be requests for guidance on that sort of thing that they would provide, because those sorts of things probably would change as well based on the change of that, 3-month cadence of reporting. The other thing, though, is that I don't think that there would be all of a sudden this just dearth of information. If you look at most companies, they're going to industry dog and pony shows all the time, and they're presenting to Wall Street. All these banks, all these investment banks, they put together these big conferences for industries where everybody presents, and you can go on their website and you can look under presentations and you can find the webcast of those events anytime you want to. So it's not like we would only get information from these companies twice a year. They're still going to release updated presentations. They're still going to be, the vast majority of them are going to.
I don't know if it's the vast majority.
I think it would be. I think it would be the companies that are doing it now would continue to do what they're already doing. They just wouldn't have to file that 8K. So I think there would still be plenty of information to satisfy investors. Jeff, I will say the biggest thing about this that I've had to force myself to try to find some objectivity, my financial incentives are heavily against this, because what's really good for people that make videos and write articles about stocks? Earnings season. It is big. I mean, it drives, 70% increase in interest. So, you and I both have some incentives that are disfavorable to wanting to see this actually change.
That's true. I have to be honest, that didn't cross my mind. I was thinking of this completely from my own personal investing standpoint, which I guess is my own financial incentive, but not so much through the podcast and video making. But a couple other things. One, I don't know if we're in the golden age of fraud, but it sure feels like there's a lot more of it than maybe there was even a few years ago.
And the platinum age.
Yeah, there you go. And I just feel like for now to be the time to require less disclosure, I think we're setting ourselves up for some bad situations. Here's what I'd like to see instead of going to twice a year earning. And this isn't something you could make a rule around, but I actually don't think it's the quarterly reporting that makes management teams take their eye off the long term. It's what they choose to do with those earnings reports. So first of all, do you give guidance or not give guidance? Right? A lot of companies don't give guidance. And I think, or they'll give just full year guidance versus quarterly guidance. You could stop giving guidance.
They give obscure stuff like adjusted EBITDA guidance, but they're not giving earnings per share, right?
Right.
Kind of thing. Yeah.
So that's something a company could do to take the focus off the near term. I would love to see I don't want to see earning calls go away, but I would love to see them treated differently. I don't need 15 minutes of the CEO just telling me how great the product is. I don't need, I don't need to rattle through the technical specifications of the new router they just put out. I almost like the ones that just hand out a written report kind of a thing and they go straight to Q&A. Yeah. There are things you could do, I think, to make the quarterly earnings less long-term focused if that truly was the goal here.
Here's my suggestion.
I don't know what the goal is here with this being initiated by Trump. Who knows what's going through his mind, but I don't think it's a desire for more long-term focus from businesses.
So there's a quiet period that managements have to go through before company reports earnings. It's the third month of the quarter up to the day that the company reports. And the idea there is, you don't want any insider, potentially very useful information to get into people's hands. If it was me, what I think the better thing to do would be to extend the quiet period 3 weeks before earnings and 10 trading days after earnings, or maybe 10 trading days before and 10 trading days after. The biggest thing that drives me crazy is they get to spend the shit out of earnings however they want to when they give the presentations. And I get the idea that you want to control the narrative. That's great. But you know what? force companies to put out financial results and they can't talk to the market for, I don't know, call it a week, 2 weeks, whatever. Like force absolute silence and nothing more than soaking up the numbers and the guidance and not hearing any kind of spin or context at all on it. Maybe that's a terrible idea, but I think for the bad actors out there, you do that and it makes it a hell of a lot harder for them to control the narrative in ways that are positive for their stock, but that are negative for shareholders that just get turned into bag holders.
Yeah. I mean, there's, again, what you're talking about is interesting because to me, it's like you're finding a solution to something where I don't know that we've identified what the problem is, right?
Yeah.
Like this is just something that our president opened his mouth and said, and I know it's not a new idea, but I don't there are other people who probably suggested this for good faith reasons. And I don't know what Trump's reason was. Like he seems to just go with whoever the last person to talk to him said, what they said. So maybe this is just like a stream of consciousness. Who knows if it even happens?
Oh, it's not going to happen.
Yeah. So we'll see. All right. We've spent 18 minutes or 19 minutes on this already. So let's move on. All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks Podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks Podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
Sometimes we take questions. Sometimes we respond to YouTube comments. And I thought this was interesting.
Comments and questions on YouTube. And yeah, usually we respond to them on the platform, but a lot of times they make for good questions for this forum too.
Yeah, I think this would be a fun one. So we did a video a week or two ago about, and we talked about coupon. So the response to that was, hi, great video, guys. Glad I found this video and the channel. Question, why coupon and not C Limited, ticker symbol SE? I'm not asking this for advice. I own a serious position in C for many years. I feel it's a better play than coupon and possibly even better than Mercado Libre. Just wonder if you considered C Limited at all. Thanks. So I used to own C Limited. There was a time when I owned, before coupon was even a public company, I believe, I owned Mercado Libre and C Limited. And my thinking was, I have a great e-commerce and fintech operator in Latin America. And I have a great e-commerce and fintech and gaming operator in Southeast Asia. And I was very happy with that. Now, this was early on in my investing life. I got impatient with C Limited. There was some weird stuff that went on. It was not profitable yet. It was still working towards that. And I sold at the exact worst time. I sold just as they were turning profitable, and the stock has done, and the business has done very well since then in the few years since I sold. So I agree with this commenter. I typically don't rebuy companies I've sold. I don't know why. It's probably some bias I have, but I had to look into C Limited recently, and I was like, oh, wow. Like I have not paid attention to this stock in a few years, and it has done really well. And the business has done really well. It's profitable. It's cash generative. It's now doing all the things I was hoping it would do when I was a shareholder. So I don't know. I think you own this at one point too, Jason.
Part of the reason I moved on is number one, their gaming platform went through a period where it was just kind of really slowing. It just was not delivering well. And some of their earlier attempts to expand in e-commerce into Latin America were struggling as well. Just kind of fits and starts there. But Garena has gotten healthier. It's done better. I think bookings were up mid-20s last quarter. So that's really strong. So their digital entertainment group, that's certainly gotten better. And that's a substantial part of the business. So that needs to do well. But the biggest thing is that if you look at the other parts of the business, e-commerce and digital financial services, they've grown incredibly fast. So what is it? Payee? What do they call their?
Payee, I think.
Yeah, and then Shopee, of course,
and
is
Shopee. Yeah,
that's their e-commerce businesses. They're growing really quickly, almost $30 billion in GMV from their e-commerce business. That's a real player, right? A $30 billion quarter. That's a real player in gross merchandise volume. It's up almost 30%. So the business is certainly growing really well. I think what's going to be interesting is we start seeing Shopee and Coupang start to hit head to head as they start to compete in some markets, because I know like Coupang is targeting Taiwan, right? That's an area they're looking to grow. Sea has some presence in Taiwan already. So it is going to be interesting to see as these companies have to start competing a little more directly, like some of the larger players like this. The one thing I'll hard disagree with is that I think Mercado Libre is still the safest growth play in e-commerce, because they are so entrenched in Latin America and there's still so much potential growth in Latin America. Yeah. And they have so much deep trust on the payment side that they've done such a good job with Mercado Pago. Whether C-Limit or Coupang is going to be great super winners, that's another story completely that I don't have the answer to. He maybe has an argument that C might be the better choice than Coupang. But I mean, there's just some things about Coupang in terms of predictability with the business that I think are pretty strong.
So one thing I think is interesting, and I didn't know this, but I looked it up while you were talking. C Limited is a bigger company. It's got a market cap of about 112 billion compared to Coupang's 61 billion. That's as of today, September 16th. But Coupang generates more revenue. They had like $8 billion.
It's not as profitable, right? It's a different mix.
Yeah, but that surprised me. Like so Coupang just brings in more money than C Limited does, even though it's a smaller company. So I agree with you. It'll be interesting to see as they go head to head in Southeast Asia, who comes out on top. They're not exactly the exact same thing. I think the Coupang seems to really be focusing on the distribution network, get everyone their stuff as fast as humanly possible, consumer happiness angle, right? Like the fact that you can, to return something, you just open your front door and put it on your porch and they come get it. Like that's pretty great. I wish Amazon would do that here in the States, to be honest.
Right.
And that's easy to do when you're in a super dense country like South Korea. Like I think they have like 1 day delivery available to like 80 or 90% of the population. But yeah, I have nothing against C Limited. I think comparing it to Coupang, I think is fair. I agree with you though. I don't put either of those two companies in the same bucket as Mercado Libre.
I think that's fair.
All right. We got a few other questions on YouTube. We had a few about the trade desk because we did a Stocks Unscripted episode on the trade desk. I don't know when it was, several months ago at this point. So we had two recent comments. One just said, epic fail, because obviously
thanks for the deep insight there.
Yeah,
YouTube
something
listener.
We said a year ago should be held against us now. Things happen with businesses. But another person was much more generous and just said, you guys should update this episode and share what you're thinking now. So let's talk the trade desk a little bit here, Jason, not for too long, but I have to be honest, of all the companies we've talked about over the time we've done this show, where there's been some huge drop, like when the outage happened for CrowdStrike, just as an example, I've generally been a buyer of the dip. And I was a little bit with the trade desk the first time it fell. I think it was 2 quarters ago, but the guidance for this last quarter was lower than, it seems like that things are going to still head in the slowing down direction. So I actually am a little bit more cautious right now, but I'm curious where your head is on the trade desk right now.
So a couple things have happened recently that hit the stock. We saw a downgrade. I think maybe it was Morgan Stanley or one of the big banks, their analyst that covers the stock downgraded it. And there's some things that are happening in this space. We do know that the ad tech business, both the buy side and the sell side, we're starting to see more consolidation and maybe a little bit of companies competing on both the buy side where the trade desk competes, working with the ad buyers. I guess it was a big deal with, I don't know how big it was, but Amazon and Netflix partnering together that could, maybe take a little bit of bite out of the opportunity for the trade desk with some of the large ad buyers that it's historically worked with. And the growth rates are slowed, right? We've seen all of those things have played out. I continue to believe that the stock price has a massive amount of negative sentiment baked into it now, because this is a business that's still growing, right, in the low 20s revenue rate. And there are potential catalysts for that growth rate to accelerate. So I would definitely take the over on this being a market beating stock over the next 5 years. It's a very dynamic space, ad tech, as we see more and more advertising shift to programmatic. And the biggest opportunity typically is going to be connected. Look, it seems like it's going to be connected TV, right? That's just where so much of the ad dollars are going to flow through, which does say, okay, Netflix is built to be a big winner with their ad tier. And of course, Disney with Hulu, that's a lot of ads that are going to shift to programmatic to over time. ESPN with the over-the-top direct subscription that they're finally, after a decade of everybody expecting it, rolling out. That's many $billion of advertising are going to flow through ESPN. So that's the supply side. That's where the ad inventory is. So those businesses doing more and more those where maybe it's harder for the trade desk to connect their buyers to those platforms through Kokai. Those are certainly things you have to consider, whether or not just the total pie and the slice of it that the trade desk can get. Does it seem like maybe that does continue to shrink a little bit? Maybe that's the case, but I think it's still really early days in this transition. And the ad business is going to just continue to grow on a global basis. And I think that all of those opportunities together, to me, make the trade desk still really, really compelling.
The other thing, we talked about this on a previous show, but when stocks have been huge, growthy winners, and then something happens where they're not, whether it's temporary or permanent, it's hard to stop thinking of them as the growthy thing they were before.
Yeah.
And, every individual investor needs to decide if the trade desk is cheap now compared to where it has been or what they think the future will be. But just to put some numbers around it, the trade desk is trading for 8.4 times trailing sales right now. The lowest it's ever been over the past 10 years is 4.4. So it's not, I know like 8 and 4 far away mathematically when you look at it by percentages, but like it has been as high as 40, 50, 60 times sales at its peak. So it is not nearly priced like it was when it was really kind of firing on all cylinders. And same thing for price to free cash flow. It's at 30, the low it has been. And by the way, these lows are back from 2017 when the stock was in a much different place, was 14. So the question I think I have for me is like, can it win from today's price? I'm more confident in that because I agree with everything you just said. I think what's probably tough is what if you bought it in November of 2021 and now your shares are down, whatever, 50, 60% from there. Do you ever see it recover to that point? And maybe the answer is yes, but like when, right? Does that happen next year? Does that happen in 5 years? So where you bought and how you're looking at your position, I think varies in terms of how you're going to think about it moving forward. But if it had seen the trouble it had seen and was still trading for 20, 30, 40 times sales, right? Then I would be like, no, this is maybe not the risk reward you're looking for. But at 8 times sales, when it's been as high as 20, 30, 40, maybe it can work from here, I guess is the way I look at it.
I think part of the way that I keep thinking about the trade desk and the fact that the stock is down this much is we've seen a little stumble and a massive sell-off in a business that's still performing pretty well. And I mean, I think 2 recent examples of stocks that have done kind of the same thing. And it's not a perfect analogy, but Amazon and Netflix, I just mentioned those as kind of being counterparties in this story around the trade desk and some of the risks. Amazon stock was off by more than half as recently as 2022. Netflix stock was down, call it 75% as recently as 2022. And their stocks now they're at all-time highs. They're absolutely at all-time highs. So Netflix got a little bit, but the point that I want to stress is that changing expectations, realigning, and then the business outperforming those expectations can go a long way towards a stock doing extraordinarily well and recovering a lot of lost ground. So the trade desk doubling from here, and we're pretty close to back to all-time highs. And doubling, I mean, I make that sound like, oh, it's easy. All you got to do is double your stock price. I don't want to need to be flippant, but this is a business that they have a few good quarters in a row. And Jeff Green say, okay, look, we're back on track. We have more work to do, but we're getting there. Those things that help. They have a new CFO, I think, that came in this summer. I mean, that's another thing that, there's probably questions. Dave Pickle left a couple of years ago, the other co-founder. So
that was a pretty big deal.
I mean, he was a sweet co-founder to have. All right.
I agree with everything you said. My only concern is, and I think I said this earlier too, like I don't understand or know enough about this space to know if the competitive threat from other companies is substantial enough that they may never regain the dominance they had. That's my biggest concern. Like I think the company's strong and will be around, but like
Nobody's taking away what they're doing, what they're good at. Nobody's leaving them to go to a competitor to replace what the trade desk is providing in terms of.
But maybe future business doesn't come to them. Like the competitive threat is the piece I'm not knowledgeable enough to be. I'm not selling my shares, but the reason I've not bought a whole bunch more now that it is literally it's the cheapest it's been in the past 5 years. If you look at the chart from the past 5 years, it is at its low.
I've added options.
Yeah. So I have to think more and learn more about it. All right, let's move on. We got other questions to get to. So we got a long email from a friend of the show, Joe, lot of basically 9 or 10 questions within it. I can't read the whole thing, but it's about stock-based compensation. So a bunch of the questions were just questions about how it works, mechanical kind of questions. But I think his last paragraph would be the fun part to discuss. So he ends his email to us. I understand that companies will continue to pay folks whatever the market will bear. And if I'm making money from my stock purchase in that company, why should I care or complain? The stock-based compensation distributions are being accounted for in the financial statements. But doesn't this seem like a compensation system that could really spin out of control? And he's just basically asking about the tons of stock-based comp you see from especially tech companies. So I thought it'd be fun to just kick around how we think about stock-based compensation generally, rather than dig into the mechanics of every single aspect of it.
Yeah, I think it's a great question. And this is one of those good kind of fundamental things as an investor, that it's a tool. And for those of you that heard our interview with David Gardner last week, talking about valuation and when to use it and when not to, and how he thinks about it, and how some of his rule breaker investing kind of principles are the things that can be easily misused, right? Sometimes on purpose to mislead people. Stock-based compensation is the same thing, right? You can fall into the trap of thinking it's an issue when it's a not issue, but also ignoring it as just a cost of doing business, but not understanding the implications. And for me, when it comes to stock-based compensation, the biggest 2 things that I've come to learn to consider is, number one, what is a company doing about it now? And if the answer is not a very satisfying answer, what are the implications if they don't? And the short version is, yes, Joe is 100% right. It is a cost of doing business broadly, but what is the per share impact to me as an investor? And generally, when we're talking about stock-based compensation, we're often talking about young, smaller tech companies that are issuing a lot of stock-based compensation as a percentage of shares outstanding. What that means is that you're feeling the dilution on your investment, and the company's not in a position where they're generating a lot of cash flow that they can repurchase enough shares to offset the new shares that they're issuing, right? So it's physically hurting the per share returns, which means the company has to grow cash flow per share, earnings per share more, or cash flow or earnings more to generate adequate earnings per share, because the share count continues to go up. You'll hear a lot of times people will look at the company's free cash flow or operating cash flow, and then they'll look at stock-based compensation. And if the company's not generating enough free cash flow to offset that stock-based compensation, then they're not really generating free cash flow. The reason why, if you think about it that way, is you continue to get diluted. And eventually companies are going to start buying back shares when they generate excess cash flow to do it, right? To try to keep the share count neutral or even decrease it over time, right? That's what you really want to see, is companies buying back a few percentage of the share count every year or two. So I think that's the biggest thing, is understanding if a company's increasing their share count 4 or 5% a year, then that's another 4 or 5% a year. They need to grow earnings above and beyond to get to a good earnings per share.
Right.
That's a massive, massive thing that you have to think about it with those companies, is because if they're not doing something about it today, they're eventually going to have to, because if they don't, it's going to ruin the returns. An example of that, I don't have the numbers right in front of me, but there was a period of time with Block, which used to be Square, that they grew, I can't remember the exact number, but they grew operating cash flow, I don't know, double. But because of stock-based compensation, over that same period, it was neutral on a per share basis. They grew free cash flow that amount. But then on a per share basis, it was basically neutral, because the share count increased so much that essentially shareholders, you were in the same place you were 5 years ago because of all of the new shares that were issued in stock-based compensation.
Yeah. And there's extreme examples like that, which absolutely are worth being aware of. But what I see happen, and this might be the genesis of this question, is stock-based compensation gets painted with a broad brush in the financial media because it's an easy boogeyman to complain about certain companies. And it's just not always that big of a deal. And it's never going to go away, and it's just part of the world we live in. And think about it logically. You're starting a business. You're a brand new startup. You have investor money, angel investor, whatever, and you need to hire people. And you need really talented people. You need engineers and scientists or whatever it is. What's going to lure a super talented engineer to your company when they could go work for, pick your big tech company instead? Well, maybe it's the fact that you're going to give them a ton of stock-based compensation and they believe in the founder and they can become very wealthy by taking less money up front and owning equity in this promising young business. So it makes sense for all the reasons that you would think, right? Companies don't have a lot of cash to pay people at the beginning. And you lure people to your small startup by giving them stock. And hopefully it all pays out for everyone. What you want to see, and you alluded to this, is over time, as the company grows, you want to see that percentage of revenue or cash flow, however you want to look at it, that's going to stock-based compensation come down as a percentage over time. And I think for most businesses, it does. It doesn't, probably more businesses than you think have stock-based compensation, but like you get to a point when it grows that you don't even think about it anymore because it's not diluting shareholders and it's just mixed in there. The one that came to my mind, I know you talked about Block, but the one that comes to my mind immediately is ASAN, because that's a stock that I follow pretty closely. And it's been like trying to get profitable for several years now. And one of the reasons it hasn't is it issues a ton of stock-based compensation. It doesn't have the top line growth to overcome that. And then what you see with a lot of companies is they start, like you said, buying back shares, but that's just to offset dilution. One thing I do, Jason, just on my spreadsheets for the companies I own is not quarterly, but yearly. I have an extra line for each company where I track total shares outstanding and then free cash flow per share. And it's my way, and I like to do it yearly, not quarterly, of just seeing like, okay, of the companies I own, which ones are over time reducing share count and growing free cash flow per share? And when they're not, I start to wonder why or ask why. Typically because it's a tech company and it's earlier on in its journey, so it's still issuing a lot of stock. But if it's one where like I'm losing patience on it getting to profitability and I'm wondering when it's going to happen, and that percentage, those metrics are not heading in the right direction, sometimes it's a sign to me that either I have to cut bait or I have to be more patient. So that's one thing I think you can track to keep track of this. That is a little more high level and can get you out of the minutia of what's happening, what the narrative is, what's happening quarter to quarter.
Yeah, I think that's good. I want to give some examples so you can think about companies in like different places in their financial journey. If you go back to the beginning of 2020, if you look at Amazon, it's increased its share count by about 5%. Over that same period, Microsoft share count's actually probably gone down. Let's see here. It's flat. Essentially flat. You look at CrowdStrike, its share count's up about 10% over that period. Now you look at a much newer, younger public company that's still trying to find its way that went public in 2021, like at the peak of, hey, here's a great time to go public and raise a bunch of money. But a lot of our comp plans don't align with how publicly traded companies issue stock, is Confluent. And their share count's gone up 37%, right? Oof. Over that same period. So you can see that it's one of the reasons why Confluent, as its results have slowed and the growth rates have slowed, it's fallen to a much cheaper valuation than CrowdStrike, which a lot of people will argue has pretty egregious stock-based compensation because Confluent is egregious-er.
Egregious-er. Love it. All right, we have one more question. And then, of course, we have the spam comment of the month. The last question comes also from our Discord. And it's actually a bunch of different questions because we had a little conversation about this. Someone asked basically about investing in restaurant stocks and if they're fads and what we think about that. And then that spawned into a conversation about like, is it better to invest in the companies themselves or maybe some picks and shovels plays, like for example, Toast, the point of sales system company. So let's talk about both of those things. Let's talk about restaurants. And I want to focus on, well, let's just do all restaurants because restaurant stocks is a fun category. What you think about them and investing in them. And then maybe what are the picks and shovel plays that are tied to that industry and whether or not they're better to look at. So what are your thoughts?
I think what I've learned largely about the restaurant industry is as investors, like we see the Chipotles and we see the...
Chipotle.
That's what I said, Chipotle. And
no, you always add an extra vowel or a syllable. I mean, it's right there in
Chipotle. Well, it's like
Chipotle.
It's like extra guac. It's just, it takes a little bit of extra sound to say it. But then you look at the McDonald's too. And they've been massive winners for investors over the long term. Even McDonald's over the past 5 or 6 years, I'll have it right in front of me, has been a market beating stock, right? And we see those and we want to find the next one, right? It's a little bit of like the siren's call of investing writ large, where we want to find the next Amazon, the next Netflix, the next NVIDIA, the next Chipotle. I just had to say it one more time for you there, Jeff. What we lose track of is that if you look in the starting a business world, restaurants are the thing that people start up that fail at a higher rate than just about anything. Restaurants are extremely low margin businesses. You have high fixed costs. The equipment is crazy expensive. It's hard to keep staffing. It's tough, right? It's very, very tough. And what most restaurants do is they end up finding the cheap real estate that's out of the way that nobody goes to, right? Because nobody knows it's there. And these chains are successful because they have access to good real estate in high traffic areas and they have cost advantages with their suppliers. But on the margins, it's still kind of the same thing, right? Having a successful restaurant and then taking it public where you've got going from 50 locations and you've got some private equity backing and your PE guys want you to go public because they're ready to cash out part of their stake, or you have real ambitions to go national. I mean, there are no guarantees that you're going to be that CAVA is going to be the next Chipotle, right? It's easy to think that it's going to happen, but actually doing it's really, really hard because the margin profiles for these businesses are extraordinarily challenges. Tastes change. You want to know why Domino's and Pizza Hut and Papa John's and Little Caesars, I think privately held, have been successful because they're cheap and they have cheap ingredients and you can stick it in a box and get it to somebody's house and it's going to be exactly the same as it was if you sat down and ate it in the restaurant, right? Mm-hmm. They're easy and they're portable and they're crazy cheap to make and they're stable. The more complex these things get, the harder they are to do well. That's what makes, to me, Chipotle such an absolute unicorn is fresh ingredients, right? Maybe the fact that you're wrapping it in a tortilla gets it close enough to pizza that it's going to travel well and it's going to be fine. But I just think it's a really, really tough space that honestly, I don't put a lot of intellectual horsepower into it, trying to find restaurant stocks that are going to be winners. I talk about it professionally. I follow them, but it takes a lot for me to find one that's going to be compelling enough that I'm going to want to own. In the past 5 years, I think Chipotle and Starbucks are the only two restaurant stocks that I bought. And Starbucks, Chipotle, I added not too awful long ago, actually about the time that they went through the management change when their CEO went to Starbucks. And with Starbucks, it's been a more recent ad on, hey, I think Brian Nichols is going to be the guy that's going to turn it around, right? And I bought them because they have this track record. They have deep value in their brands. They have pricing power with their suppliers or cost advantages with their suppliers. Network effect benefits that they have because they are so large in the scales that they're at, predictability. And I just think they're better bets than betting on a CAVA that's going to, I mean, you're already buying 5 years worth of growth when you buy CAVA, right? With these other restaurants, you're not buying really any growth at all. I just think it's hard to find the winners and you're better off finding the stalwarts than just staying with the stalwarts.
The framing of this question is what I struggle with because the question was referring to these restaurants as being fad stocks. And ironically, I don't think of restaurants as fad stocks as much. Like that word I use mostly when I'm talking is I use that word when I say why I don't invest in like clothing brands.
Yeah.
That's why I've stayed away from Lululemon and On Holding, right? That's where I think, fashion and what people wear, I think is much more fad prone than where people eat. For me, it's a different thing. Like I tried to Google this while you were talking, but I couldn't really find hard numbers, but I found enough internet resources and I have enough life behind me to say there's a lot more restaurant brands around me, at least now, than there were when I was 35 and then more than when I was at 25 and more than when I was 15. For a Starbucks to pop out of, where it started and for even Chipotle to do as well as it's done, these are companies that have had long track records. And I know they've been winners for a long time, but they were coming out of a place where there was just less competition. And now it seems like every time a new strip mall goes up around me or a new building is built that's going to be a restaurant, it's a brand that exists and I Google it and it's around from some other part of the country, but it's not one I was familiar with because I didn't have it near here. And so I think of it less as like a fad and more that it is just an incredibly crowded space. I mean, especially if you live in a densely populated area like I do, like you can get within a 20-minute drive, like almost any restaurant you want. So it's more about the competitive space to me than it is the fads. And Chipotle was, I think, like a unicorn, right? It was the first sort of quick service that was quote unquote healthier. It traveled well, like you said. And Starbucks kind of the same thing, like the first like real big, I mean, I shouldn't say the first, like Dunkin' Donuts was there, but like really kind of revolutionized that space. And now every coffee company that comes after Starbucks is just trying to be Starbucks. And every fast casual restaurant that goes public is trying to be the next Chipotle. And being the next fill in the blank typically doesn't work out for the company trying to do it.
Yeah.
So it's more about the competitive nature of the space for me than it is that they're fads. And then I guess the last thing I'd say is, because you mentioned what happens when you go public, investors want their money, they want growth. So what does a company do? They expand, right? Oh, this company's only been in the Northeast. Let's try the Midwest. Let's try the Southeast. Let's try the Southwest. And not all brands travel well.
Well, the incentives become detached from the business's potential.
Yeah.
Yeah. No, I think that's right. Couple things to add real quick here, I think, that are just useful, that do highlight some things you're talking about. There's not a lot of ETFs and indexes that like follow the industry that you can invest in, but there's one that I think is kind of interesting because I think it exposed some of those things. Advisor shares, actively managed ETFs, and their EATZ, EATZ is their restaurant ETF, and it has 20 or 25 stocks. So it's small, and the mix of it is interesting. Something like 63% of it are small caps, which I think that says everything you need to know about how difficult the restaurant industry is. And I decided to take a look at some of those holdings, and the largest holdings, Nathan's Famous, the hot dog company, BJ's Restaurants, which is a sit-down restaurant business. I remember probably 12 or 13 years ago when it went public to raise money to grow, and the stock has probably lost investors money over the past decade. It is a tough grind of a business, and getting to like that scale, man, it's just no, thank you. No, thank you.
Agreed. And real quickly on the picks and shovels aspects of this, that may be a more fruitful place to look, but yeah, I have the same competitive advantage. I still haven't pulled the trigger
on Toast, and I think that's probably the best play on that,
Right. I have a hard time separating the anecdotal evidence from the business results, but I was at a restaurant this past weekend and the bill came and the waitress said, if you scan that QR code, you can just pay on your phone. So
it was Toast.
No, it wasn't. It was flawless and easy.
Yeah.
It was great. It was like, scan the code, put the tip in, Apple Pay. So 2 clicks on my iPhone.
Yep.
Done. And I was like, holy cow, that was better than Toast. And I Googled the company and it's a private company.
Yep.
That this restaurant uses. Now, I have no idea what the back end is like, and maybe it's a hot mess, but it just proves my point that if you go out and just pay attention to point of sale services, depending on where you live,
they're a dime a dozen. They really are. They really are. And they largely compete on price. I mean, that's generally what they're competing on.
Yeah.
So, yeah.
All right. That's it for the listener questions. Let me end, as we always do, with the spam comment of the month. And as usual, it's going to come from Twitter, the spam capital of social media. So here's one that I think is good for you, Jason. Hey, bro, do you want to grow your followers and boost engagement? We've got the right solution for you. I just like it because it just decided that it's a comment on our show account, and it's, hey, bro, like, we're friends. It's casual.
Let's be honest. If you were going to identify like a type for the Investing Unscripted podcast, probably would be a bro.
And I have no problem with that. Word. It's just, it's a pretty casual way to try to pitch your services to someone. So anyway, that's our spam comment of the month.
Yeah. I should respond in the voice of the podcast. Dear sir, I will have you know, I am not a bro.
There are so many of these. I mean, we could do this all day long. Just constant spam on Twitter, X, whatever you want to call it. So, all right.
Thank you, Elon. Thank you for the segment.
Yes, thank you.
All right, we're done. That's it, right?
That's it. Wrap this thing up.
All right, friends, we love it when we get a chance to, at least once a month, answer your questions in this format. And then the other days of the month where we do a show where we answer our questions as well. But always remember, they're our answers and we're happy to give them, but it's up to you to find your own answers. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.